And welcome to Taking Stock for the week ending 9th of September 2022. My name is Jason Yin, and joining me today is my colleague Daniel Ortisi to stream to you all things share markets. Now, our head of research, Kian is taking a well-earned break, so I'll be hosting in the interim. Before we get started, just a few ground rules. A reminder that the information provided today is of a general nature and therefore should not be considered personal advice. Shares are volatile, so any charts and tables presented should not be relied upon and as a guide for future performance. So let's kick off today's session, Daniel, with a quick overview of Tuesday's RBA rate hike.
Yeah, thanks, Jason. The RBA lifted interest rates by a further 50 basis points to 2.35%. The action was well expected by both the market and economists and marks a fifth consecutive rate hike. The rise in debt costs have begun to place stress on financially unhealthy businesses as we begin to see an uptick in business failures towards the lower end quality of the market.
Right, so if we were to compare the Australian market's financial health to the previous year, the chart on screen suggests that it has deteriorated over the period, with fewer companies ranked as strong financial health, while the number of companies in marginal and distress ratings has increased.
That's right, and there's been several factors contributing to the change in financial health, specifically COVID disruptions, supply chain challenges, the Ukraine-Russia conflict, cost inflation, which all collectively have driven many companies into financial distress. Furthermore, inflationary pressures and rising interest rates are reducing consumer purchasing power, which negatively impacts companies' earnings. Consequently, we observe an upward trend in Australian bankruptcies over the calendar year, as shown by the chart on screen.
That's right, Daniel. And as we continue to enter a period of heightened financial stress and difficulty, we remind investors the importance of investing within financially healthy businesses. And on that note, let's head into some of the star stock highlights for the week. So, Australian tin producer and star growth stock MetalX delivered a notably strong FY22 result. Revenue over the period was up 144%, while earnings per share grew eightfold. And this was driven by a 19% increase in tin production, an 80% increase in realized tin prices, and there was also relatively flat operating costs. Furthermore, the bumper profit result improved annualized return on invested capital to 76%, and earnings quality remained strong on healthy cash flows from operations. So the fundamentals appear quite strong, Denny. What prompted the market's negative share price reaction?
Yeah, so we feel that the market is increasingly cautious about the recent decline in tin prices from a high of around $49,000 a tonne to dropping towards $24,000 a tonne. The price production will most certainly impact revenue and profits over the next 12 months. And as MetalX is a single commodity producer, there is little it can do to diversify the risks associated with a volatile tin price. Furthermore, the stock has had no analyst coverage in the past, which increases uncertainty and tends to lead to higher volatility. However, we decided to retain coverage of the company as a star growth stock due to its strong financial health rating, which was supported by a cash balance of over 120 million, which is almost half of its current market cap. In addition, most of these active risks do appear priced in at this point in time. Now, the share price remains bearish on the SD Max and the SD30 TSR, so trend-sensitive investors should remain on the sidelines, while opportunistic investors who see the fall in tin price as an opportunity and are comfortable with the active risks could consider a position here.
Right, thanks for that, Daniel. Moving on to another Aussie miner, we initiated coverage of gold miner Gold Road Resources as a borderline star growth stock.
Yeah, Jace, Gold Road, it's a company that we're familiar here at Lincoln Indicator. It's a low-cost gold producer with a 50% interest in the Gruyere gold mine, which is located in Western Australia. The remaining 50% interest was sold to Goldfields Limited in 2016, and that helped de-risk the project and provide the development capital.
Right, so we can see that there was a reported strong growth in the first half 22 revenue, and also the return on invested capital was a healthy 18%. However, I'm looking at Stock Doctor right now, and earnings per share growth was negative. Are you able to quickly highlight why this was the case?
Yeah, sure thing. It's important to point out that this was an interim result for Gold Road Resources, and the earnings per share figure has been impacted by a poor second half 2021 result, which was weighed down the annualized figure. On an interim basis, the first half 2022 earnings per share increased to 4.52 cents per share from 2.17 cents per share in first half of 21, which is a 108% increase on the prior comparable period. We regard Gold Road as a genuine growth stock because the company is expected to grow production in both calendar year 22 and 23, which is driving consensus forecasts of earnings per share growth in the triple digits and improvement in return on invested capital. Furthermore, Jace, it's also positive to see that the price of Gold Road is in a bullish trend on both the SD Max and the SD30 TSR. And furthermore, the company is covered well by 9 analysts and is currently trading at a discount to consensus share price targets, which may reflect opportunity for longer-term investors seeking exposure to a gold miner with development and exploration upside. Be mindful, however, because the price targets are based on commodity prices, which are volatile.
Thanks for that, Daniel. There's a lot of information to sort of peel back on. Wrapping up some of the highlights this week, we have wealth management firm Perpetual Limited. Danny, I know you covered some of the active risks and that prompted the removal of it as a borderline star growth stock post its FY22 results and proposed merger with Pendal Group.
Yeah, definitely, Jason. Firstly, the higher than expected cost guidance from wage inflation and elevated headcounts, in addition to recent weakness across financial markets, led to negative earnings revisions over the last 3 months. Therefore, FY23 earnings are projected to decline by up to 17%, and the stock is unlikely to meet the linked growth criteria in February 2023. Secondly, the sizable merger with Pendal Group carries a significant element of integration risks, and especially if the anticipated cost synergies are below expectations. This helps explain why the forecast is declining in terms of return on equity in FY23 to around 13%.
Right. So while some of these active risks pose a threat to its growth profile, we believe that its above market dividend yield is sustainable, considering there is enough headroom within its payout ratio, which currently sits at 80%, and that the current yield offers a large enough buffer above the current market yield. Therefore, we have retained the coverage as a star income stock.
Yeah, Jason. Additionally, the stock is actually trading at a discount to consensus price targets. However, we believe that this may be warranted, considering the heightened active risks and especially at the merger, the risks that the merger entails. Finally, if the company does report well in February and the integration risks settle, we may reconsider its coverage as a growth stock.
All right, and on to the corporate calendar. It seems like there were no company updates expected next week. Star Income Stocks, DTH1 Limited, South32, and Spark New Zealand are due to go ex-dividend on the 15th of September. Right, so in Under the Microscope this week, we are going to focus our lens on lithium producer Allkem. The company was formed by a merger between Orocobre Limited and Galaxy Resources in August 2021, and its operations span across Argentina and Australia.
Yeah, that's right, Jason. We initiated coverage of the company as a borderline star growth stock after the company posted significant uptick in its FY22 financial result. Revenue soared almost 900% year on year as lithium prices reached an all-time high. In addition, net profits swung from a loss in FY21 to a profit of around $337 million US. The record revenue and profits translated to an increase in return on invested capital to 26%, which satisfied Lincoln's growth criteria. Investors should note that Stock Doctor is showing not applicable for earnings per share growth as it's coming off a negative base. Furthermore, growth rates may appear astronomical due to Allkem being a recently merged business and the financials have been restated.
Right. So I noticed in your initiation report, Daniel, that you pointed to the company's substantial growth pipeline. Can you please expand on this a little further?
Yeah, definitely, Jason. Allkem will be benefiting from the Olaroz Stage 2 development, which is scheduled to be completed in FY23 and reach full capacity in around FY25. This should triple its production profile at the project from around 13,000 tonnes to 40,000 tonnes of lithium carbonate. Additionally, Allkem is developing other projects in both lithium production and processing. All of these factors should bode well for earnings per share growth over the medium term.
Right. So just to provide members with a bit of, I guess, color on what's actually happening, we're actually showing a photo of the Olaroz project in Argentina on screen right now. Daniel, can you please walk through how they actually extract lithium from these ponds?
Yeah, sure. Well, the Olaroz project is a lithium brine project which operates by pumping mineral-rich water to the surface into these evaporation ponds. Over time, the sun evaporates the water and leaves behind a mineral-rich brine, which is processed and treated further and produces lithium carbonate. This is why the stage 2 development at Olaroz has a lag between construction and full capacity of production, because it's a very time-consuming process of filling these evaporation ponds and waiting for the sun to do its work, essentially.
Fascinating stuff, Daniel. Almost like drying tomatoes out in the sun, but obviously in liquid form. I'm not sure if that's a great example or not. But anyway, moving on, in terms of some of the risks, Allkem's financial performance seems to be tied to the price of lithium. And this has skyrocketed due to the imbalance between supply and demand. However, as the global production grows over the next few years, lithium prices are anticipated to moderate. And this remains the most important active risks to monitor. With a growing asset base, Allkem has the potential to grow future earnings, even though there could be a moderation in the price of lithium, which is a positive.
Yeah, moving on to management, Martin Perez has been the CEO since Orocobre was a standalone entity. He has a significant experience in the resource sector, specifically in South America, where Allkem owns a considerable portion of its assets. Martin has reduced his holdings in the company to fund tax liabilities associated with the issuance of performance rights. And while we don't like to see management selling down equity, it is anticipated that his performance rights will vest, which brings his total holding in the company higher and should align himself to shareholders in the near future.
All right, on to the question of the week. So reporting season is finally over, Daniel, and we're getting a little bit of a rest now. But some members would want to usually compare their portfolio performance with star stocks or a benchmark. So how can you do this? Well, you can accomplish this via Portfolio Manager, but it displays two types of returns, a dollar-weighted and a time-weighted return. So what's the difference between the two, and which one should members use?
Yeah, it's a really good question, Jace. And first off, let's start by going onto stock.dot and clicking the Portfolios tab and selecting your portfolio. On the right side, you'll be able to see the cumulative return of your portfolio compared to a selected index, such as the ASX All Ords, Star Stock Portfolios, or international indices. Note in this section, there are two types of returns, as you mentioned, time-weighted and dollar-weighted return. Time-weighted return, as the name suggests, reflects the returns of an asset over a period of time, say 1 year. And that return is considered to be the best comparable return when you're contrasting two assets against each other. On the other hand, a dollar-weighted return is a return of an asset taking into account the purchase price and the timing of when you were bought and sold. As such, this return is not as useful when comparing one asset to another because it considers the individual's unique purchase price and timing. In essence, unlike time-weighted return, the dollar-weighted return is impacted by both the size and the timing of the cash inflows and outflows.
Thanks for that really in-depth explanation, Daniel. So in summary, when an investor is comparing the performance of assets, say comparing the performance of Lincoln Star growth stocks against the All Ords, they should be using the time-weighted return. However, the dollar-weighted return is unique to an individual's own portfolio and shows how their performance has tracked, taking into account timing and the purchase price. Well, thank you so much for your input this week, Daniel. I hope we did the program the justice it deserves.
Yeah, it's been great, and I'm looking forward to joining you again in the future. And as always, since we've discussed so many things on this episode, if members feel like they need to ring up and have any questions, we'd always be happy to take on those questions and speak to you directly.
Fantastic, fantastic. Well, if you did enjoy today's episode and looking for more educational tools, then consider joining our Lincoln Live sessions every Monday, where we talk about market strategies and answer your questions on stocks. So in summary, higher interest rates are beginning to separate the financially strong companies from the weak. Stock Doctor's financial health ratings can help minimize a portfolio's exposure to potentially insolvent companies, allowing Australian investors greater confidence and control in achieving their investment objectives. Thank you, everyone. Thank you so much for your time. Take care and have a safe and healthy week.